Welcome back traders, welcome back community. This is episode 3 in our mini tutorial series. This is Crypto Bullseye, and in this episode we're going to talk about time frame analysis. If you haven't watched the first two, in episode 1 we talked about how you identify a trend and how you apply trend lines to your charts. Episode 2, the stochastic RSI, what is the stochastic RSI and how that works in sync with the momentum of price action on your chart. This is episode 3, time frame analysis, and let's get into the tutorial. But before we do, if you do like this content guys, if you have watched the previous two and you do like the content, give us a thumbs up, share it with your friends, subscribe to the channel, and don't forget those notification bells. So, time frame analysis. What is time frame analysis in trading? Well, we spoke previously in the channel that each of these candlesticks represents a specific trading time frame. So I'm on the 6 hour here, so each one of these candles represents 6 hours. Now, within every trading strategy, you should have built-in time frames, usually a minimum of 2, one to identify the direction of the trend at a given time, and another one which would be your entry points, the trading time frame, to find the best entries within that higher time frame. So what type of a trader are you? That's the question that I want you guys to ask yourself. What type of a trader are you? If you don't know that, keep watching and you'll soon find out what works for you and what doesn't work for you. But if you don't know the question, if you do know the answer to that, I want you to ask yourself another question. How often can you be at the charts? Now, this is dependent on what type of a trader you are, and it's dependent on how high a time frame that you're going to need to be trading from. And let me give you an example of that. So if you've got a full-time job and you're working all the hours under the sun and you don't get to look at the charts until once a week, then you should be trading on a minimum of the weekly chart, because all that candle price action is going to happen within the week. It's going to take out all the noise of the smaller time frames, and then you're going to be able to just concentrate and focus on the individual candlesticks once a week. You can set your targets, you can set your stops on that weekly time frame. So as far as this strategy is concerned, and during this example I've got a 6 hour time frame and I've got a daily time frame, and the reason why I've got those two time frames is it's because it's a 4:4 ratio. So if you divide the daily by 4, you'll end up with 6 hours. If you divide 6 hours by 4, you'll end up with 90 minutes. And it's okay to have the 90 minutes as your watching time frame to find out if you can get a better entry, and use your 6 hours as the trading time frame and your daily as the identification of the trend. That's completely fine to do, but we're going to keep it to 2 in this example, and we're going to use the 6 hour and the daily. So let's have a look. Right, okay, so we're in the 6 hour, so we're in our trading time frame, and we can identify that we're pretty much in a ranging market. It's trading sideways. So what we'll do is we'll apply our extreme highs and lows of the ranging market, and we can apply some lines to the chart to identify those ranging lines. So this is the area that we're trading in, and we're on the 6 hour. We're looking at entry points in the 6 hour. We can go into the 90 minute to find a different entry if we want confirmation of something such as a double bottom, and within our rule set we say we need price to come back, confirm, retest, and you might need a higher high, higher close candle, which means the candle closes above the extreme high of the previous candle. You could have that built in your rule set. We're going to talk about Japanese candlesticks in the next few episodes. So depending on what is within your rule set is dependent on what time frame you're going to be entering, and more importantly, the higher time frame is always going to be to identify the direction of the trend. So we always hear the expression swimming with the whales. We want to be flowing with the flow of money, and we need to ensure that our entries are in line with where the institutions, the whales, the professional traders, whatever it is, whatever you call them, we want to be buying with them and not against them. So that's the importance of time frame analysis. So we're identifying in the daily, in this example, dividing the day by 4 and you get the 6 hour. If you were looking for specific price action targets, like the double bottoms or the higher high, higher close candle, it's fine to go into the lower time frame, divide the 6 hours by 4 and you get the 90 minutes. It's fine to do that. But your trading time frame, remember, is going to be the 6 hour, and your identification of trend is going to be on the daily. So I hope you like this episode. It's only going to be a short one. This is the importance of time frame analysis. Share it with your friends, hit the notification bell, subscribe to the channel. Thank you very much as always. Appreciate all your support, guys. Thank you. Enjoy your day. Bye.